In a prior video, I discussed several indicators that are flashing warning signals of a possible recession. Those include the fast decline in stocks coinciding with the implementation of policies likely to increase inflation and consumer prices and pinch consumer spending. A rise in treasury yields, even though stocks are cratering, a bad sign, in my opinion, indicating that many investors, for whatever reason, no longer view them as safe as they once did view them, or otherwise find them undesirable based on what is happening in Washington. A decline in the value of the U.S. dollar that has accelerated today against major developed foreign country currencies, and the decline in commodity prices, particularly crude oil and natural gas, which are cratering in price. All of those indicators are, in my opinion, crowdsourced opinions, and they may turn out to be wrong. But they all point in the same direction, a probable worldwide recession caused by one man who never, ever takes responsibility for his own actions when the result is unfavorable, illegal, or unconstitutional. The buck will never stop at Trump's desk. Financial websites are claiming now, based on confirmations received from the White House, that the minimum tariff on China's exports to the U.S. is now at 145%, higher on some products. I previously thought the number had been increased to only 125% based on some stories that I read at the financial websites. But, whether it's 125 or 145, China's exports to the United States will slow down to a trickle in the coming days and weeks. While China has raised its tariffs so far to 84% on U.S. exports, which are close to 150 billion or so last year, and have placed export controls on rare minerals that the U.S. needs, China has more options to retaliate, ranging from increasing its tariff rate to banning the export of rare minerals, or just making it difficult or even impossible for U.S. firms to operate in China, an important market for many companies. I have declared a trigger event in my VIX asset allocation, which is a negative stock market signal, which ushers in an unstable VIX pattern that is more of a dicey stock market with wild up and down swings, and more suitable to traders than investors, buying the dip and selling the rip kind of trader. I discussed that declaration in a comment that I just left in my March 3rd, 2025 post, where I republished a 2014 post discussing this VIX model that I have. The model was developed in a few minutes after I first viewed a long-term VIX chart in early 2007, and the pattern just jumped off the page to me, since I knew what was happening in the stock market when the VIX was moving steadily below 20 for long periods of time, and then what happened when it spiked into the 20s and 30s and even higher. The unstable VIX pattern can evolve into a catastrophic decline in stocks that has in the past presented long-term buying opportunities. An example is the catastrophic VIX spike in October 2008, which was accompanied by a significant decline in the stock market during an unstable VIX pattern created by the August 2007 trigger event. That is when I started to use all of my cash flow in October 2008 to buy common stocks. I am buying stocks using the criteria outlined in my prior video published today. Corporate bonds are becoming more attractive, and I bought several today as investors are becoming more concerned about even investment grade corporate bond risk. And the rise in intermediate and longer term treasury yields is not helping those bond prices, corporate bond prices. And the treasury yields are falling, notwithstanding the decline in the significant decline in stocks and a decent inflation report released earlier today, and that is troubling. Anyone buying now may be faced with simply adding to their losses with new purchases, and any new purchase has to be made with that firmly in mind. That just goes with the territory in my experience. The nation was in a recession, and the 10-year Treasury was yielding over 10% in August 1982, one of the best buying opportunities in my lifetime. But stocks nonetheless started a robust rally that would last until March of 2000 in the summer of 1982, where the annual average total return of the S&P 500 was over 15%, adjusted down for inflation. But it started, and there was a robust rally when it was still, looking at the economic news, the economy was in terrible shape. Interest rates were too high, and inflation was too high. But the stock jocks decided that the problem that was causing all of the decline in the stocks and the long-term bear market that started in 1966 had been solved by the Federal Reserve Board that had driven the federal funds rate up to maybe slightly over 20% and basically had stuffed out inflation by killing the economy. I am not yet to the point I was like in October 2008, where I will be using all of my cash flow from interest and dividend payments to buy stocks. I'm more gingerly approaching stock buying now. But that is more of a testament to my financial condition and the lack of any need to take equity risk until at least I feel more comfortable with the risk-reward balance than I do now.